Hello, everyone, and welcome to another Altos Trading Live strategy session. This is Richard Van Rich here with Jeff Tompkins, and we got Craig Ward in the chat. And still may have Homa and Daniel on. This is definitely a special event. Thank you guys so much for being here with us tonight. A lot of great information to go over again. If this is your first time on, I know we got a lot of folks that are just now joining. They get on at 6:30. Your microphone's muted. That's so we can all hear Jeff talk. And if you have to hop off for any reason, this is recorded and will be available in the members area later tonight, and also on YouTube sometime tomorrow. If you have any questions about your Zillion access, trade alert memberships, access to trade train, anything like that, you can email support@altostrading.com, and we'll get to those tomorrow. So before I bring on Jeff, let me just read the disclaimer one more time. Trading securities and options involves risk. Part of buying and selling an option, investor must receive copy of characteristics and risks of standardized options. Investors and a broker to trade securities and options must meet suitability requirements. Past results are not necessarily indicative of future performance, and performance figures are based on actual trades, including real money results. Due to the time-critical nature of trading, broker fees, and the activity of other subscribers, there's no guarantee that subscribers will mirror performance, and performance numbers shown are based on trades users could enter based on the trade signals. So Jeff, hopefully your green screen's working.
Well, I'm gonna, I'll stay off camera right now. Because we're going to hop right in on this pretty quick since we're running a few minutes late. So yeah, no, thanks for the intro, and welcome everybody. So some great stuff to go over tonight. We'll start out with our market overview. And obviously we've seen another leg lower in the markets, but we are at a significant potential inflection point and major support across the major indices. So we're going to be focusing tonight on targeting buying opportunities in down markets and scaling in. So on our session last week, we talked about more on the money management side about scaling in and out of positions. And tonight we're going to build on that a little bit and talk about that in the context of identifying potential buying opportunities in down markets. And then we'll shift over to our ticker symbol roundtable and have you guys share anything that you guys want to look at together, and then wrap up with our Q&A. So let me get over to our charts, and let's see here. So we're looking at the let's actually look at the SPX. We're on the SPY. All right, so I mean, we broke a major support area, and this was a commentary I posted last week in Zillion, and emphasized the level that we were looking at, in a bit more of a zone again, between 4,100 and 4,000. So 4,000 is a millennial mark, right? And on the S&P, that it carries a lot of weight behind it, and as a support level, and we've traded below 4,000 now 2 consecutive days. So yesterday we dipped down to 39.75 and change, and then a bit lower today at 39.58 and change. So yesterday we actually closed below 4,000. Today we closed above. All right, so just barely, right? Just a little over a point above that 4,000 millennial mark. So we want to be watching 4,000 very closely. Now, 4,100 is going to be more of a resistance area moving forward, now that we've had a couple closes below 4,100. Let me zoom out here just a little bit for you guys. And so you'll see that, and I'm going to kind of emphasize this again as more of a zone, that we've got this, and I'm going to kind of mark several of the century marks here. 4,000, 4,100, 4,200, sorry, 4,100, and then 4,000. are were the major support areas that we've been watching. So the one that's really still in play as far as support is the 4,000 level. And now 4,100, 4,200 are more resistance zones. So you can see that in the past, we've had some strong moves up off of these century marks. Had a whole lot of price action around the 4,200 level back in earlier last year, March, April, May, before we saw that large leg higher up into the previous all-time highs. So 4,000 is a really significant level to be watching as it relates to support. And if we have any more closes below 4,000 this week, I suspect that we'll see a further move lower to lower levels of support. If 4,000 holds, then we're looking at a potential bounce back up into resistance zones like 4,100, 4,200. But now that we've traded down into the 4,000 level, those are going to be major levels of resistance, the 4,100 to 4,200. And now, so if 4,000 breaks, we'll be looking for lower levels of support. And 3,850 is a significant one to be watching if 4,000 breaks. But always keep an eye on those century marks, 3,900, 38, 37, 36. And we've got some stronger support down here, closer to 3,650 and 3,700. Okay, so this zone here, 3,650 to 3,700, if we get down here, is going to be probably a pretty strong one. So maybe, depending on what happens, if we reach that level and how price reacts to it, might be a potential buying opportunity. But any of these levels of support could be at least short-term buying opportunities, and that's what we're going to talk about tonight. So we have a couple strong levels of overhead resistance at 4,200 and 4,100. Right now we're at a millennial mark. So if price can stay above 4,000, that's near-term or short-term bullish. If we break, that's going to open the door to more of a significant leg lower into some of these lower levels of support that we mapped out here. So a lot going on right now. And again, the catalysts haven't changed a whole lot. There's, it's Fed tightening and inflation or a big one. The Russia-Ukraine war, and those are probably kind of the two biggest factors right now. Earnings have impacted the markets as far as bearishness goes. So we got several variables or catalysts that are causing this whole shift in market structure from this decade plus bull run that we've been in. And another thing that's on my radar that hasn't necessarily hit the markets yet, but I think will sometime in the next, possibly this year or into 2023, is housing. So we've been in an extremely hot housing market, but typically when we see Fed tightening, which results in rising interest rates, and mortgage rates just went up and are at new highs, and inflation, that's eventually going to hit the real estate market, right? So we need to obviously keep an eye on that, because what happened the last time there was a real estate bubble, if you guys were in the markets back in 2008, we know that the markets lost over 50% of their value in the second half of 2008. So that is something to keep on the radar, and we'll be watching closely as well. So we've got some bearish sentiment factors that we need to be looking at as we take into consideration the technical levels on the major indices. So that's what we're watching on the S&P. So it's a big week. This is an important week because of this 4,000 level. We have had a strong move down since late March, early April, and a move off this 4,600 level down into the 4,000 level. We've lost over 600 points on the S&P, which is a lot. And we're going to actually, after we look at the VIX and the NASDAQ, come back to this and talk about gauging peak to trough sell-offs and using those in conjunction with these technical horizontal levels. So let's look at the NASDAQ. And the NASDAQ, I think, is down somewhere around 25% peak to trough, maybe a little bit more. But there's a big level to be watching, horizontal technical level to be watching, right around 12,200. And so we could see a near-term bounce. Oops, sorry about that. We could see a near-term bounce from 12,200. But we've got a lot of overhead resistance on the NASDAQ too. So I'm sorry about that. All right, so this technical level right around 12,200, 12,300 was major support back early last year. So you can see that prior to that, going back to late 2020, we had a lot of resistance there. So it took pretty much the better half of the year in 2020, in the second half of the year to break through that. And we hit it multiple times and didn't finally get through it until around the beginning of November. And then once price broke through, came back down, retested, and then that what once was a resistance level then became support, and then we get this very big move in the NASDAQ up off that level. So we're now back down to that level. Believe it or not, I mean, we haven't been down here since over a year ago. So the NASDAQ, in just a matter of 4 months, a little bit more than 4 months, has lost everything that it's gained going back over a year ago. And that's how the markets work. They tend to wipe out gains much faster than they produce them. So this is another strong level. So both the NASDAQ and S&P have very strong technical support levels that we're at. And that's good because we want to watch to see what price does off those levels. If that level holds and we see a move up off of it, that can give us more confidence to play the long side into resistance. And there's very strong resistance. And this, by the way, is important because this broke since our last session last week at 13,000. So millennial mark. And then of course, 12,000 is one we're watching. So as well. So we're kind of wedged between two millennial marks, 12 and 13,000, 13,000 being the area of resistance, that if we get a bounce off this 12,200 level, or if we can stay above 12,000, that would be our major level of resistance to keep an eye on. So if 12,000 or 12,200, because let's actually look at the low from back on March 5th was right around just a little bit above 12,200. Low from yesterday was a little bit higher, 12,000, or sorry, a little bit lower, 12,136. And then we've held that today. So watch 12,200 as a century mark, and definitely watch 12,000 as a millennial mark. If we break and close below 12,000, we've got a lot of room to drop on the NASDAQ. So that would be very bearish. And we could even be looking at a leg lower into 11,000. And then 10,500. Right, so these are some of the major support zones to watch if 12,000 breaks. Okay, a lot of support there from back in 2020. So some really, we're at some very key levels. I think the fact that we've had such a, this pattern is very similar to what we see on the S&P. We've had such a parabolic sell-off in March and April, and then of course, continuing into May. There might be some opportunity to buy off these levels if they hold, or if we get a trade trend buy signal. And then if we look at these charts in the context of the VIX, we want to watch, because remember what we've emphasized so strongly in the past. When we're at a major support level on the major indices, the NASDAQ, the S&P, we want to watch for those levels to hold while the VIX is hitting resistance zones and retreating. We got a little bit of that last week, but then the VIX spikes up again. So we're kind of playing around with this 34 to 36 resistance area. And so if those major support levels that we're at now in the S&P and NASDAQ that I mapped out there for you guys breaks, then we could see a VIX spike, above this 34 to 36 zone. We haven't gotten above much above that on a closing basis since back in later 2020. We touched above it a bit the beginning of 2021. And it wasn't until mid 20, let's see, that was right in the June, so right around the middle of 2020, we spiked up above 44. So if those levels break, watch for a VIX spike up into higher levels of resistance. But if this 34 to 36 zone can hold and the NASDAQ and S&P can hold those support levels, then we might see more of a near-term bounce. I just don't expect it would be very large because there's just not a real catalyst there to push the markets higher from where they reside. But that doesn't mean there can't be some buying opportunities. That's what we're going to look at here shortly. So I'll pause there and see if we have any questions that have come through, Richard.
I think most people are probably just kind of shell shocked. Looking at everything. It's one thing to kind of see on the news every day and kind of looking at charts, but as you're explaining it like you are, I think a lot of folks are just really looking at it like, there was a comment in chat from Steven saying it was just, since NASDAQ has gone back to the lows of COVID, it's scary. I think a lot of people are just really kind of sitting on their hands wondering what to do. So
yeah. So that's going to be kind of the topic of our session tonight. So one thing that I'm always doing is I'm looking at not just the horizontal technical support and resistance levels that we look at together on our sessions, but also particularly in market downturns or full-on bear markets, which as far as the NASDAQ goes, we're in a bear market on the NASDAQ, is peak to trough sell-off. So there's a couple ways to gauge those. They're kind of like Fibonacci levels, right? There's some user subjectivity, kind of depends on where you start and where you end up as far as gauging a fib level or a peak to trough sell-off. It's a bit easier right now because it wasn't long ago that we hit an all-time high. Right now we're back looking at the NASDAQ. November 22nd of last year was our all-time high in the NASDAQ at 16,746.86. So what I'm constantly doing is gauging the percentage decline from a previous high. So we could use, this is where the subjectivity comes in a little bit. We could use the start of the year, which isn't that far off from the all-time high back in November. But being that it's so close, I would generally use the all-time high in this case. So what we want to look at are percentages. So and then look at kind of what's going on a macroeconomic scale and geopolitical scale, and maybe look for ties to events in the past. So the last real major bear market we were in was in 08 during the housing bubble. And this can help us identify buying opportunities as markets hit new percentage level lows from peak to trough. And then also we can use these in conjunction with the technical horizontal levels, and also with money management techniques like scaling into positions. So again, that was a major topic of our meeting last week. So if we look at let me get my trusty calculator out here. The percentage decline, right? So if we go to the previous all-time high in the NASDAQ at 16,764, we'll just round here, 16,764, and we look at the low from yesterday, right? So this is the lowest price that we've seen since that all-time high at, so we're going to subtract this from the high, right? The all-time high, 12,136. The NASDAQ from peak to trough has lost 4,628 points. So again, this is not on a closing basis. This is from the high to the low, the peak to the trough, 4,628 points. You can also do this based on closing price. But if we take that that point decline and turn it into a percentage, we would divide that point decline back into that high that from November 22nd last year, which again was 16,764. All right, and that's a 27.6% percentage decline, right? So that's a huge decline in a short period of time, right? So November, so about 6 months, about half a year. So it's not as severe as what we saw in half a year back in 08, but point being here, it's some level, disregarding the geopolitical events, risk, and Fed tightening and things. At some point, prices are going to become attractive to buyers, right? So markets aren't going to go down forever, and at some point, they're going to create really good buying opportunities for more of the medium to longer term. So it really helps to mark these peak to trough percentage declines. And so the ones really I think to watch, so again, we're just, have breached 25%. But the ones really I think to watch are, you want to watch like the 10%, because that's what's kind of considered a correction zone, 10% from peak to trough. And then if that breaks, we often see moves down into 15% declines. So every really, my rule of thumb is every 5 percentage points, we want to be watching very closely. So 25% now, and then we've slightly broken that. So the next one, we'd want to map out what the peak to trough decline would be on price wise at like the 30%. And we know that when things get really bad, and if the market were to lose 50% of its value from the previous all-time high, historically speaking, that's created incredible buying opportunities. But since we don't have a crystal ball, we don't necessarily know, although we can try to edge the odds in our favor as much as possible by mapping out our major support levels, technical levels. We can also use these peak to trough percentage declines to help as well there. And since we don't have a crystal ball, that's where the scaling can become a really valuable tool as far as money management when trying to identify long opportunities within bear market conditions or major market sell-offs. So these are levels that I watch. So while I'm not advocating necessarily buying, or investing at these levels, if we hit a 30% or greater level, those can be good areas to start accumulating shares of, and this is more, by the way, on the broader indices. We've seen much larger percentage declines in individual names, for instance, individual stocks. So this is more like on the major indices, the S&P, the NASDAQ, to help determine kind of the broader potential turnaround levels, to then go in and fine tune when looking at individual names. If that's something that you're trading, many people stick to the major indices. And I think in these types of scenarios, major indices can be great investment vehicles versus trying to pick individual names. Because a lot of times individual stocks will get hammered and stay low even when the market rebounds. So it can actually be a lot more difficult to spot opportunities with individual names versus focusing on the major indices. So in these types of situations, I like to look at the majors, the NASDAQ, the S&P. The Russell's a good one to watch, and we'll talk a little bit about that in a second, because it's an important one to consider as well. But those are that's something to look at, is the peak to trough percentage sell-offs, and then look for those to also match up with the technical support levels that we've been mapping out on our sessions. And if you can find confluence between a major percentage peak to trough level, like let's just say 30%, since we're approaching that on the NASDAQ, and you see that align with a technical support level, and then you see price hold and start to move off that level to the upside, those can create buying opportunities. And same goes with the S&P. So the NASDAQ, of course, is sold off more significantly than the S&P, but let's take a look at the S&P on a peak to trough percentage basis, so we can also kind of see where things currently reside. So the all-time high in the S&P actually came in at the start of this year on January 4th. So let's pull the calculator back up. So, and while I'm doing that, so the point of scaling in is, again, we don't know how far the market's going to fall, and we don't necessarily know where exactly the turnaround is going to be and how far it's going to go up. So that's where the scaling in component becomes crucial and a really valuable tool. And if you weren't on the session last week, that's posted in our YouTube channel. It's a good one to watch as it relates to scaling when we're talking about entering or buying at a major level, whether it's technical or peak to trough. So the high that we hit in the S&P back on January 4th was 48.18, and the low from today was 39.58. Oops. All right, so that's an 860 point peak to trough drop. And then we're going to divide that point drop into the peak, the high. We have a peak to trough of just a little under 18%. All right, so again, peak to trough levels to be watching are 10% for a correction. Okay, so we've obviously surpassed that. 15%. So these are potential turnaround points. 20%, not quite there yet. 25 and so on. This is the one on the S&P we want to be looking out for. We want to see if 20% holds if the market doesn't trade peak to trough lower than 20, and that coincides with, it doesn't have to be exact, but with is nearby a technical support level like we mapped out at 4,000. So 4,000 holds, that's above a 20%, but close to it, just about right around 18%. So again, these can be treated more as zones than exact levels, but this is the one that we're really looking at right now in the S&P at this 4,000 level. So, if I were looking to, for instance, initiate a long position in the S&P, these are the things I would be looking at. And then that's where I would start transitioning over, if I make a buying decision, into money management and scaling tactics. So if I want to start building a long position in the S&P, starting at, let's say, 4,000, because let's say, although I'm not confident yet, I see this level holding and then price start to rebound from it. Well, then I know that this 20% peak to trough is holding, 4,000 is holding, a millennial market and a technical support level. And maybe I want to start building a position, but I could be wrong, right? So this is where I might scale in. And these are levels that I use for scaling, not just the technical, but let's say I start building a long position in the S&P at around a 20% peak to trough, but then it declines further to 25. So these 5% intervals are areas that I would look at adding to the position or scaling in as well. So if I'm right, then great. I was right off the bat, and I have the potential to make some money. If I was wrong, I still have the potential to make some money because I haven't built my entire position right off the bat. With the thought process of having a crystal ball and I know exactly what's going to happen. Instead, I'll be prepared to be flexible and adjust my position size at lower levels should the S&P or whatever I'm trading continue to decline. And so these peak to trough percentage levels are, for me, good scaling endpoints on a continued decline if I'm building a long position. All right, so let me pause there and see if there are any questions on peak to trough sell-offs as it relates to the market's conditions that we're in right now, or any of the technical levels or volatility index that we've looked at so far.
Chris kind of threw in a point wondering, would there be concern over the Fed tightening as well as a rate? I think his autocorrect set up, as well as say a rate hike in June. Would that supersede these levels?
Yeah, so the thing with like Fed tightening is, to some degree, you have to watch out for surprises, but to some degree, it's being factored into the market right now. So I don't look too far ahead. It might, if there was a surprise and they became more aggressive with rate hikes, one of their meetings, then that might result in shorter term volatility and potentially have some longer lasting effect. But generally, like around FOMC meetings, we see increased volatility, but not necessarily sustained moves based on that one meeting or one rate hike decision, because a lot of times and a lot of the movement you see around Fed meetings is based on whether it's hawkish or dovish Fed speak, based on what the Federal Reserve Chairman is saying versus actually doing. But again, that's usually more shorter term volatility. So yeah, a lot of what we're seeing now is just the anticipation of these future rate hikes, which can be good, because even before things get uglier as far as Fed tightening, the market can sometimes precede that in terms of hitting peak to trough lows and creating buying opportunities. So you can kind of sometimes, in some cases, get ahead of the game there. So hopefully that kind of answers that.
Yeah, and there's another question, kind of more sort of towards housing. I think maybe we can hit it towards the end.
More towards housing, you said?
Yeah.
Yeah. Okay, so that's what I want to talk about as far as using peak to trough sell-offs and finding confluence between those 5 percentage point down moves. 20 is those percentage intervals are not all equal either. Like 10 is a big one, 20 is a big one, because again, 10 is what's considered correction, peak to trough, and then 20% is what's considered bear market. So we're not quite in the bear market yet with the S&P, but we are with the NASDAQ. So those are big ones to be watching, 10 and 20. But then those 5 percentage point intervals are also important, especially when they line up with technical support levels for identifying whether it's a more of a short-term buying opportunity into a resistance zone, or if you're more of a swing trader or longer term investor, those 10 percentage point intervals from peak to trough can also create, especially when you average down, dollar cost average, or scale in, really good buying opportunities, because without a crystal ball, we don't know where the bottom is, but we can use those as a good gauge for turning points back to the upside when the sell-off is finally decides to be over. But another thing to consider too is look at the time horizon, because bear markets tend to be shorter term than bull markets. So we might see a year or two of sustained downturn, and then when you get into a secular bull market, it can last well over a decade, as we've obviously witnessed in the recent past. So more to come here, and I think this is going to be a topic of a conversation for us with our members for many weeks to come. But it's kind of exciting because there's eventually going to be some really attractive buying opportunities when the dust settles here. So we'll continue to map these out and monitor the peak to trough percentage sell-offs, and of course we haven't talked a whole lot about trade trend tonight, but be watching for the buy signals off of these percentage peak to trough percentage levels, as well as that one didn't trigger, as well as off of the technical support levels, because those can create some good opportunities. Currently in the S&P, we've got a triggered sell signal. This is one that I've ignored personally, because it was into that millennium level of 4,000. So it's triggered, potentially has room to move lower if 4,000 breaks, but I ignore a sell signal at the bottom of a move or a buy signal at the top of a move. I want to really see these off of a level. So we'd want a buy signal off 4,000, not a sell signal into 4,000. Or if 4,000 breaks and then price comes back up and retests, then I'd be looking for a potential sell entry or a sell signal there on those. So
I got a quick question on the VIX.
Yeah.
If it retreats, he's noticing that it's kind of retreating to a little bit higher level the last couple of times. It's not quite gone down below 20.
Mm-hmm.
Do you think if it retreats the next time, you see it kind of going back below 20 again, or you think it's still going to kind of hover above?
Yeah, good question. So I think it's going to stay elevated above 20 for a while. And the reason I say that is, and we've talked about in the past, is to get generally what you'll see like with a brief sell-off, and this is more of like when you're in a bull market or a big uptrend, and it's just you get a little bit of brief panic or profit taking or whatever the catalyst is. You'll see a quick spike and then a quick drop, back starting below 20 and then back below 20. So this one started below 20, back below 20, started below 20, back below 20. So these are all, I can tell you without even looking at the S&P, what happened to the S&P and what the market conditions were when these spikes occurred. So this is kind of more of your, I'm in a bull market or an uptrend, and just a little bit of a brief, correction, or not even a technical correction, but a profit taking, or what would create a normal trend, even when you're in bullish conditions. What's changed here this year is with these spikes, we're not getting really back below 20. We're remaining above 20 largely, a few brief dips below 20 there. And we're seeing these spikes last longer, especially this one in February, March. You see how many trading days here we stayed above 20, whereas like these are very quick, right? Within a couple of weeks, you're down, up, and then back down. So these quick ones basically tell us that we're not really in a bear market. We're just in bullish market conditions with brief little downturns. When the VIX is staying elevated above 20 largely for many weeks or months, as it is now, we're generally going to get these, it's kind of works the opposite, right? We get little dips back down in the VIX, followed by another spike up. So we're still at this major resistance zone, 34 to 36, early 38. Again, this in conjunction with the major support levels in the S&P and NASDAQ could indicate that we move back down in the VIX a bit, but getting back down below 20 would be less likely, because right now our support on the VIX is kind of right in the 19 to 20 zone. So I think it's going to take a real shift in market structure. If you see the VIX go back down below 20 and stay there, that to me is the real strong indicator that there could be a more sustained turnaround to the upside in the major indices. So that's something to also be watching and used in conjunction with the peak to trough percentage sell-offs, as well as the technical support levels. So all these should be really used in context with each other. The VIX below with a sustained closes below 20 and definitely below 18 will be our major indicator that, assuming that the major indices have based at one of those peak to trough percentage levels or a technical support level, would be where I might, if I'm building up a long position, and let's say the S&P, where I might finish that off and add, my full 100% allocation that I was, willing to, in terms of risk exposure, willing to take at that point in time. So good question there. All right, well, we've got about 10 minutes left or so. We want to take a couple symbols if you guys want to take a look at anything together.
So some guys were like had it ready to go. Let's look at IWM.
Okay. Oh, thanks for, I was going to look at the Russell 2000. Forgot to mention that. So the reason that, when you look at small cap, that's a lot of times like when economic things are getting bad economically, it really hits, the small cap companies bad. And so the S&P, or sorry, not the S&P, the Russell 2000 can be a good economic gauge. And I think more so than like the S&P or the NASDAQ. So IWM is the ETF that tracks the Russell 2000. It's a good one to watch. And although we don't generally do our market overview and level mapping on the Russell 2000, I encourage you guys to do that as well, because it can give us also a good leading indicator of economic conditions, and often will even precede down moves in the S&P and NASDAQ. And in fact, you can see that. So remember how we looked at the peaks in the NASDAQ and S&P just shortly before looking at this chart of the IWM, and remember how the NASDAQ peak price occurred, I think it was what, 1122, and the S&P not until the start of this year. Well, the IWM hit its peak back earlier in November. So this is again a good gauge to watch, and can sometimes give us leading information as it relates to the other major indices like the NASDAQ and S&P. And you can see that obviously IWM got hit really hard back in November before the NASDAQ and S&P hit their peak prices and moved lower. So again, that started here at the end of March on this most recent leg lower. And if we look at the IWM, let me zoom out because we're now looking back a year at lows. So let's go back 2 years and look for, so we broke a major support right around the 185 level. And looking back historically, we've got not a lot of support until around, roughly around the 160 zone. And that area was resistance from back in 2020. So more room to move lower here on IWM. And there was a sell, pending sell, also on the IWM. Yesterday triggered today. So this one potentially has room to move lower. I'm just kind of looking at futures right now. It looks like they're starting to move back down. So yes, this one I think has room to run down before finding more support, around the 160 zone. And if we see like that 160 zone hold and price move up off of it, that again could create some buying opportunities. But again, look at the peak and the trough and calculate your percentages. So you have an idea of knowing, like, are we in correction territory? Are we in bear market territory? Are we in market crash? Like, where are we relative to previous all-time highs?
All right, Stephen, this was part of the real estate one earlier. Could you look at KBH, KB Homes?
Yeah. Yeah, so these are, it's obviously gotten hammered pretty hard this year. Was trading up around 50, currently trading in the low 30s, but these are ones that can often get hit hard, and obviously in bad housing markets or housing bubbles. There's it's playing around with some support around kind of roughly around 30 to 32. So 30 is major support. More recently 32. Currently a lot of price consolidation going on. So this is one thing I've mentioned in past sessions. I avoid trading something that's just chopping sideways. So there's a lot of price consolidation. So these more recent buy and sell signals haven't triggered at their entry price, but I would ignore them anyway, just because there's a lot of consolidation. But this 32 level is strong support, as well as 30. And I do see a nice buy signal there off 30 from the past. There's one there too. So if 32 breaks and price moves back down into the 30 level and there's a buy signal, might be good for a quick couple points back up into 32 resistance. If 32 holds and we can get out of this price consolidation, then I think that it has potential to run up into closer to the 38 level. So that's just at first glance, the one that really pops out is strong resistance, which previously served as support on many occasions. And there's resistance. So a lot of strong levels here on KBH in terms of support and resistance. And this is this 32 to 38, or even 38 to 30 are the major zones between the strongest levels of support and resistance.
Yeah, his question was really, he wants to see the ticker, but I think I wanted you to explain that first before I ask the question. His is more like more of an insight on the fact that, the stocks themselves are having, revenues and earnings that are beating expectations, but the stocks are still going down.
Yeah, exactly. Yeah, because I think partly they're probably moving down with the broader markets, but also the anticipation of raising, mortgage rates going up and housing prices potentially peaking. And housing usually gets hit hard during inflationary periods. Housing prices get overinflated, people get priced out of the market, and then inventory dries up, which then results in Fed tightening and rising interest rates. And then not only is there no inventory, but what is left of the inventory, nobody can buy it because the rates are high, right? So that's where it creates like a housing squeeze and ultimately, potentially a housing crash. So definitely something to consider. But yeah, a lot of this, these sell-offs are probably in tandem with the broader indices and also the anticipation of rising mortgage rates, which is already starting to happen.
Yeah. Let's see.
Let's take one more.
Yeah. This one came in. IIVI.
All right. So did you say V as in Victor?
Yeah.
Not familiar with this one. IIVI, Roman numerals. All right, so yeah, strong support at around the 60 level. And I'm just mapping out like the most obvious support and resistance I see. There's going to be more support and resistance within these zones. But let's see, big one there. So these are major support to watch around 55 and 60. That's some nice buy signals off this off this 60 level. And then 55, got a good buy signal there off 55. But this stock is, when we look at anytime you look at a symbol, probably one of the first steps is tell yourself what it's doing. Paint the picture for yourself. Tell yourself the story. And the story here is this. IVI is in a range. So the stock is basically just ranging up and down, and ranging stocks can be good plays. If you see that we've got a lot of sell signals near the top of this range and a lot of buy signals near the bottom of the range. And historically speaking, many of the times off this lower end of this range, the 55 to 60 zone, it's gone back up into the 75 zone. And conversely, when it's been up in that 75, near the 75 level, and we've gotten sell signals, it's moved back down into the 60. So this is good information to have, obviously, and the importance of mapping out these key support and resistance levels and using those in conjunction with buy and sell signals from the trade trend algorithm. It's another good one to look at. But yeah, basically in a range. And I always ask myself, when something's in a range, is the range strong enough to play? And in this case, I would say yes, because you've got a big percentage, point percentage to work with from the lower zone or support area to the higher zone or resistance area. Over 15 points. 20 points if you used 55 is the real strong lower level there. So this might be a fun one to play if we get near one of those levels. Right now we're near 60, so that's one I would watch, and 55 is one I would watch. And if we move off of that, that could be an opportunity for another leg up. But again, I want to see clear moves. So like this is like a clear, more well-defined move. I don't want to see a lot of price consolidation. This is more consolidation, choppy price action. And these tend to be things that I avoid. I want to see a well-defined move down, followed by a well-defined move up, with really just one or two touch points and not like 10 or 15 of them like over here. And so I try to avoid that price chop. Makes it more difficult. All right. Well, thank you guys. Those are great suggestions. I appreciate you sharing those. They're great ones to look at. If you guys were on our Zillion session before, we made a lot of really great updates to the Zillion dashboard. And we'll include that in the recording in case you guys missed it. But we are offering 50% off the membership for our Zillion dashboard. And you can now, one of the really great features that was added since our last major update are trade alerts. So you can create custom watch lists and within Zillion and actually receive emailed trade alerts based on your watch list. If there's a new buy or sell signal or a trailing stop level is adjusted, or a trade is, a signal is closed out, you can be alerted by email on a daily basis to all of those. So a really great new feature in addition to some others that we highlighted on the session tonight before starting our market overview. And urge you guys to go back and watch that. But we're offering 50% off our Zillion membership through Friday of this week. So it's only $49 a month, which is half off the regular price. You're grandfathered in. So it's a great opportunity. The link is there, altostrading.com/last call. Richard will post that in the chat now as well for you guys. And again, you're grandfathered in at the half off rate, and you get the full suite of tools and indicators that come with the Zillion dashboard, which is all cloud-based. So you can access it from any browser on desktop, laptop, mobile. It's mobile friendly, iPad, any device where you have an internet connection. Okay, well, thanks so much again, guys. I hope you have a great rest of your trading week. We'll plan on seeing you next Tuesday, 7 p.m. Eastern. And if you have any questions in the meantime, shoot us an email, support@altostrading.com. We'll see you next week. Thanks, Rosemary. Thanks, Ed.